Okay, let's go ahead and kick things off. Good afternoon, everyone, and thank you for coming today. My name is Christine Short, and I'm VP of Research at Wall Street Horizon. Wonderful to see you all. We have a great program set up for you today. For those of you that are not familiar, Wall Street Horizon curates extremely accurate corporate earnings data for forward-looking corporate events, so that you can make and not lose money. We support institutional clients with an edge for your investing and trading needs. We appreciate you all being here today. I think this is now our 5th Data Minds event, which we are happy to host to connect you with and give you access to some of the best independent thinkers in the industry. So we encourage you to listen today, ask any questions you might have, and connect with any of the speakers afterwards. So now on to our program. Let me go ahead and introduce our moderator for this session, Tim Baker. Tim has been a builder and innovator in fintech for the last 20 years. Following a long stint at UBS, Tim ran content strategy and innovation at Thomson Reuters Refinitiv, laterally creating Refinitiv Labs, a global team of data scientists and designers, leveraging AI, machine learning, alternative data, and blockchain. Most recently, Tim led IEX Cloud, an innovative market data API serving institutions, fintechs, and individuals. I think we're all going to learn a lot today, so without further ado, Tim, the floor is yours.
Great, thanks, Christine, for the intro. I'm really delighted, and thanks again to the Wall Street Horizons team for putting this event together, and welcome to our esteemed panel. I'm very excited about the event. So we thought we'd kick off with a quick survey. Just one question. This is for everyone that's on the call. And the question is quite simple. What is behind the recent increase in retail trading activity in markets? Now, let me kick off the poll. So I'm just going to launch that. Hopefully you can see the poll. While you're choosing up to 3 answers, so if you could limit it to 3, that would be good. I'm just going to run through 3 kind of intro slides for the discussion. Needless to say, and regardless of how it's measured, direct engagement by individuals, or what we call retail investors in the markets, has dramatically increased just as we went into lockdown back in March 2020. Believe it or not, it's actually quite difficult to measure retail flows. And while the US equity market is by far the biggest and most liquid and the most efficient, trading is scattered across 16 exchanges, 32 dark pools, 150 brokers who internalize. So, and trades are not tagged as retail, but certainly some insights can be gleaned by analyzing the consolidated tape and looking for retail type trades. But it's quite a difficult quant activity to do that. My friends at IEX helped with the right-hand chart that shows the percentage of off-exchange retail trading against the total market. And many retail brokerage platforms like Robinhood trade through non-exchange counterparties in return for payment. We'll talk more about what they call payment for order flow later on. Together with the explosion in retail trading, we've seen so-called meme stocks grabbing attention and in several cases driving unusual trading patterns. And this week, the SEC came out with a report on GameStop. It was actually called the Staff Report on Equity and Options Market Structure Conditions in early 2021. Bit of a mouthful. It's actually a pretty interesting read. It's 45 pages. And if you don't want to read the 45 pages, go to Patrick Boyle's YouTube channel. He does a really good breakdown of the report. There are some great charts in there, and here are a couple. The one on the left shows the sheer growth in active retail accounts trading GameStop. And yes, that peaks at about 900,000 retail accounts. The right-hand side shows that while there was a short squeeze, which is indicated by the small orange bars, and they will certainly have contributed to the price rise, the pure buying power of the herd dwarfed the short covering related buying. So the report also mentions, gets into the detail behind that, and also mentions, I think what's interesting is that a bunch of institutions were also piling in on the back of retail and buying stock. The report touches on lots of other interesting aspects of how the market was working, including market interruptions, circuit breakers, and interestingly, that some off-exchange market makers had to lay off trades into the public exchanges. Anyway, the conclusions are definitely worth a look at, but I don't want to preempt what we're going to get into in a few minutes. Finally, Robinhood was mentioned 33 times in the report. This chart is already out of date. Robinhood now has, I think, over 22 million customers, and the average age of the customer is 31. I think Schwab is over 50. I actually have accounts at both, so I'm dragging both those numbers up. They allow fractional shares as well as access to IPOs, and of course, zero commission trades. The interface is really simple, and new accounts get a free share. And it used to be that when you trade, you got a little fanfare. They've stopped doing that now. Okay, so let's see how the survey's gone. Let me pull up. So I'll do end poll and share results. Okay, so new trading platforms like Robinhood, 61%. Second was social media platforms such as Reddit. Obviously, Reddit played a huge role in terms of organizing the herd and creating a lot of the hype around this. People having more time on their hands, I think we can all relate to that. And then this notion of fear of missing out. I feel I'm missing out on crypto yet again at the moment. Okay, so that's the survey, and we'll share that after the formal presentation. Okay, so very unscientific survey. Let's get on to, I'm going to stop sharing first. So hit stop share. Okay, so let's get on to the main part. And again, I just want to remind everyone, if you have any questions, drop them into the Q&A. I'll try and keep track of that as well, and as will the other people. Okay, so let's get into intros. So if each of you could wave as I mention your names. So starting with Jess. Jess is the CIO of Active Strategies at Geo Capital Management. She oversees active portfolio management and research teams and drives strategic initiatives that contribute to investment performance and portfolio risk management. Previously, she held positions at Fidelity, Quantopian, and Thomson Reuters, where I actually had the pleasure of working with her at Thomson Reuters. Okay, I've lost my... Okay, here we go. Asha is managing partner and CIO at Global Delta Capital, a quant-driven investment company that invests in emerging markets and fintech, and with an eye on sustainability. Prior to this, Asha was a PM at Acadia and an investment banker at Goldman. Chris is a recognized expert in the alternative data space, having held senior roles managing data strategy and acquisitions at WorldQuant and Exodus Point Capital. And Chris founded CP Capital, which advises firms on how and where to source alternative data. And Franklin is the co-CEO and Chief Strategy Officer at Orion Trading Systems, a provider of multi-asset trading software. I first met Franklin when he was running the award-winning Fidelity Investments research platform. Okay, so that's the intros. We've kind of got three sections here. And the first section is really about the regulator. And as I mentioned, the SEC has recently been very vocal about what's been going in the market. And I wanted to start with Franklin and really kind of get your thoughts on where the SEC is kind of coming from, where do regulations need to catch up, and frankly, how successful do you think the SEC is going to be? They have a pretty ambitious kind of plan there, and I'm sure you've read through that whole report now, so it'd be great to kind of get your take on that.
Thanks. The SEC has been on a journey ever since the crash of '87 to try to even the playing field for retail investors. They offered things like SOS and SelectNet to make sure that retail investors' orders got in there, the order protection rule that guaranteed that retail investors' quotes would be seen in the market. the the display rule, the order protection rule, so they won't be traded through, the 605 and 606 reporting. Since we're talking about data, they also established the SIP, which is the consolidated quote feed that, as slow as it is, that everybody kind of has to get access to. So they've done a lot of things, and each of those things they've built on top of what came before. So while they talk about doing a bunch of things like banning payment for order flow, that's actually going to be both challenging and not necessarily fruitful. Robinhood could just as easily internalize, and they're not going to stop that at this point in time. There are some things that they could do quickly and easily. They could change the tick size so that things that trade actively don't have to be quoted in a penny. The other thing that they could do, and the most opportune one, is really changing the definition of what a round lot is. So when they first defined it, 100 shares might have been a $3,000 order. If you want to buy a round lot of Google today, it's 250,000 shares. And so those quotes don't get reflected in the market. I think the most, as much as they talk an ambitious game, I think you're seeing evidence that they're going to regulate via enforcement and or the threat of enforcement more so than actually rulemaking, right? So Coinbase said, we're going to come out with an interest-bearing account. The SEC came out and said, we think that's a security, don't do it. And they were like, oh, okay, we won't. And so you've been seeing more and more of that. And I think that's how they're going to do it. When they talk about gamification, right? Brokers are going to think twice now about what they do because they know they're in the gun sights.
Right. And that paper, I think right at the beginning, made it very clear, this isn't a regulation. It's really, there is a lot of guidance in there for market participants. Right. So just on payment for order flow, I remember when I used to pay about $9 a trade, and now I pay nothing. I don't think I pay for trades anywhere. And my understanding is that actually the cost to the retail investor is probably lower than it's ever been. It's zero to me, and I'm probably getting a price better than the NBBO, right? So why would they focus on payment for order flow? Is that kind of part of the thinking? Are they just going to kind of quietly back off, or is there another agenda that they want to have a go at fundamentally changing market structure?
I don't think they're going to fundamentally change it because there are too many people that are aligned with the current market structure. People like Robinhood customers as well, right? There's 20 million people who, if Robinhood had to start charging a commission, are going to go after the SEC saying, why did you do this? We had a great deal, now you took it away. So I think, again, if they threaten people for bad behavior, I think they can get 90% of what they would want to do. They can go into every broker every year and say, okay, let's do an examination about how you routed your orders. That's going to keep most people on the right side of honesty.
And you mentioned the kind of warning shots. Gamification was mentioned in the report, and I think already Robinhood's already backed off from the champagne kind of popping when you buy a stock. Is that as far as that will go, or do you think there'll be any concrete changes?
Well, Robinhood's actually facing another challenge because in Massachusetts, the head regulator is Bill Galvin, Secretary of State, and he's trying to pull Robinhood's license because he said what they're doing with that and what they're doing with options is violating the state's fiduciary regulation. So he's coming after them for that. So they not only have to worry clearly about the SEC, they've got to worry about the regulators in Massachusetts, and clearly Letitia James in New York, is the hammer to many, many, many different firms in the industry.
Right. And I think about a third of their trades are actually options as well. So it's a big piece of what they're enabling in the market.
Right.
Ashley, you cover markets outside the US, and you're also an expert in ESG. Can you talk a little bit about how you're seeing kind of regulators more broadly thinking about those topics, ESG, how to protect investors, and how to provide maybe better information for retail investors?
Yeah, sure, Tim. I'm happy to jump in on this. I think there are lots of parallels in international markets, including related to the role of the retail investor, where that creates an efficiency and opportunities for institutional investors. I know we'll come to opportunities later, but for now, in the context of the regulator, far and away where I'm seeing the largest regulatory action in international markets, it is in the context of sustainability, and quite honestly, it aligns squarely with the same types of trends that I'm seeing at the SEC level here in the U.S. I'll give you a data point that I find really sort of amazing. Tim, you had mentioned you've got FOMO related to crypto. Of course, big headlines this week with the launch of the Bitcoin futures ETF being one of the largest ETF launches in history. In fact, it was second only to an ETF that was launched last year, BlackRock US Carbon Transition Readiness ETF, launched in April last year. So as much as I'm seeing these trends around the meme stocks, crypto, and sort of the various thematics that are approaching today, I really see the trends towards sustainability and ESG to be quite material. Some of these numbers are just mind-blowing. That BlackRock fund I mentioned is the only ETF that launched with more than $1 billion worth of volume on day one. AUM and ESG related ETFs have increased by over 200% over the last year, and they're only going up from here. It's catching certainly the attention of retail investors, institutional investors, and of course the SEC as well. The SEC, like the rest of us, is seeing that this is an area that's quite ill-defined. There's a lot of heterogeneity across investors when it comes to ESG. What does ESG mean? It means different things to different people. Retail investors interpret it oftentimes differently from how institutional investors do. And not knowing what you're investing in, of course, creates risk to investors. And I'd argue, especially retail investors. So where I'm seeing the SEC start to take action from a regulatory standpoint is on the context of disclosures. Specifically, climate change disclosure is one of the key areas of focus right now. Lots of interesting potential implications here. Fundamentally, changing what's in public company quarterly and annual reporting to include some ESG metrics. That leads to development of a whole new area of security analysis. Again, I think it applies to both the retail and the institutional level, really causing investors to think when you're investing in an ESG stock or an ESG ETF, are you buying what you really think it is? And quite honestly, I could see this going either way. I could see it leading to much higher flows, the rise of impact investing as a mainstream investment strategy. And I could also see in the near term risk of the ESG bubble bursting. So really, really interesting area to watch.
Do you think there's an overlap between the demographic of individuals who are more ESG engaged? I'm thinking the younger, my kids are very kind of aware, much more aware of those facts and issues. And of course, this new retail boom has really been driven by a much younger demographic. So is that where those kind of that community starts to form, ESG and trading, more actively trading in the markets?
Yeah, it's an interesting question. I think we're seeing the rise of these two themes somewhat independently. Right, the rise of ESG or socially responsible investing becoming a mainstream perspective. Obviously, SRI, socially responsible investing, has been around for decades, but the idea that you can invest this way at scale is kind of a novel concept. It's been around in this integration context and getting traction for about a decade, and in the last few years, getting a lot more traction. Separately, of course, with the rise of technology and all of these solutions that we're talking about on the fintech side, it creates opportunities for dislocation and rising access. You put those two themes together, and I think you're exactly right, Tim. I think there's definitely something there that retail community is seeing opportunities to put capital to work in the ESG space, not just at the security specific level. It's not even just at the ETF level, but with the rise of direct indexing, Seeing a lot of acquisitions of large shops today, looking for solutions to give to investors, younger and older, anyone who's interested in seeing capital allocated alongside their values. These custom solutions are increasingly accessible and attractive.
Yeah. Any other thoughts before we move on to the next topic from other people?
I'll just share a quick thought, to add on to the regulations. I think payment for order flow, gamification of stocks, these are easy media type of headlines. This is a little bit of a personal anecdote, call me an ape if you will. But, this all became a media frenzy because people were buying these stocks one day, and these companies, Robinhood and some other ones, just shut off the ability to buy more. So these are a lot of first-time investors that are coming into the market. They think they can buy and sell stocks, and their ability to do so was shut off. That's where all the investigation started, with payment for order flow, and there's confetti if you buy a stock on Robinhood. I don't think that retail investors really care about that. They never cared about payment for order flow before they felt betrayed. And that's what a lot of the, on the disclosure piece, in Europe, for example, short disclosures are much more regulated. Insider transactions are reported in a variety of different ways. Here, you get the 13F every quarter, and people game that. Options are often excluded from that. Shorts are excluded from that 100%. So there's no transparency on the other side of that coin.
Yep.
And I think that's where a lot of this investigation happened. The fact that Robinhood catered to young investors who happened to be in an order flow relationship with Citadel, who happened to bail out a company who was heavily exposed to these two stocks that they happened to shut off. I think that's really the theme of the whole retail boom and that viral craze. And it's less about people revolting against the payment for order flow type of business model.
Yeah, makes a lot of sense. Thanks, Chris. Okay, let's talk about the institutional investor, because obviously on the other side of the market is institutions. I think most of them are investing for us, retail. So it's, most of the money is really retail. It's just being applied in a different way. I want to address this to Jess and to Ash. What are your observations? What's your take on how this kind of increased retail flow has affected how markets work, and how you as professionals in the market kind of have to kind of factor in new sources of information?
Yeah, I mean, I'll maybe offer a perspective of, at Geode, and I won't speak for Geode and our investment philosophy, but just at Geode, there's sort of two big books of business, so now I've did most of my career in active, and now I've had a lot more exposure to passive management. So, maybe first kind of thinking about passive, it's a pretty interesting model, very, very thin margins, and the answer key is published every day. So it's very clear whether you're doing what you're being paid to do. And there, you're really looking at minimizing operational risk and trying to find liquidity and make sure you can match that answer key at the end of every day. So in passive, anything that changes how that process normally works is just a source of operational and liquidity and otherwise risk that you're looking to stay out of the way of. The thing that's interesting is I haven't heard a ton of concern on the passive side about this, because as I think we've seen, while overall retail participation has gone up, it's pretty concentrated, or at least this high volatility introducing behavior has been pretty concentrated. And I personally kept sort of wondering, well, will this spread, right? I think we all were thinking when it was GameStop, was it, and then it was AMC, and then it was going to be BlackBerry, and then, and everyone was scrambling to get data sources to say, wait, what can I check where the next one, and is this going to become this like real whack-a-mole everywhere? And it was funny because I was kind of remembering back to a thing I had observed when I was at Quantopian, and there we had all, retail customers. We had people just writing code who typically were like software developers or maybe not professionals. And one of the problems we saw there was we were trying to get people to think about the overall stock market and take this portfolio view. And they kept just want to write algorithms to trade Apple or Tesla. And I was like, for the love, there's stuff other than Apple and Tesla. Like, why don't you do something other than Apple or Tesla? And everywhere I would go look, like, at the time people were talking a lot, like stock twists is a big thing. And you go look, some of these other crowdsourcing platforms like Estimize, right? I would be submitting estimates on Estimize, trying to see how that would work. The number of people wanting to estimate Apple versus any other stock, the disparity was like 100 to 1 or 1,000 to 1. So what I think is interesting from an institutional investor, either passive or active, I've been involved in very highly diversified investment strategies in either case, where you're really looking to have very low active exposure, if any, to any single stock. So this retail phenomenon, because it's been so concentrated, I think has been, for me, in what I've seen, more of a isolated kind of risk mitigation type of problem versus a real either systemic problem to deal with, or a it hasn't necessarily aligned with like an opportunity that you could try to follow or profit from. So, pause there, but that's sort of been my, kind of professional exposure to it, I guess.
Cool, Jess, thanks. Asha?
Yeah, sure. I'd agree with a lot of the comments Jess put forth, certainly strongly with this notion of looking across a broad universe of securities. I agree that the themes we're talking about have been relatively narrow in the context of the US market, over the last couple of years. But of course, I think there's risk for this type of phenomenon to extend these securities and into more. You mentioned before, Tim, that my background is in international investing. And, I think it's interesting here, we're struggling with this concept of what do we do with the rise of the retail investor, and how does this impact the way we think about institutional allocations? This is something that I've thought about for a long time, and I actually see from an institutional perspective, the rise of retail creating huge opportunity. As an institutional investor who's looking for dislocations in stock prices, mispriced securities, this is what creates opportunity. I'll just give a little context, given the international background I've had to date. You're absolutely right, your opening comments that the US is the largest stock market in the world, and I couldn't agree more that doing the type of retail versus institutional analysis you just talked through, very, very complex to do. Little known fact that the second largest equity market in the world is actually an emerging market. Shouldn't be a surprise that across the emerging markets, the largest one is China. China's been under the radar for a long time because historically, up until just a couple of years ago, the equity market was totally closed to foreign investors. So, or the onshore market. If a foreign investor wanted to invest there but couldn't, foreign ownership limits were literally set to zero. Foreigners couldn't access it. The market's liberalizing now. That creates investment opportunity for international investors. Large market, like I said, second in the world in terms of market cap, number of listings. To your point on the complexity of those analyses, I'm actually seeing it to be the most liquid market in the world. So let's call it on par with the US. And what's fascinating to me is that what drives the liquidity in China is the retail investor.
Yep.
And where does the retail investor in China get their insights from? It's these technology platforms. They're getting them from WeChat. And even more so, where are they trading their insights? They're trading them on cell phones. And I've heard it said that actually there are times when half of equity market trading volumes are being executed by a Tencent, which is a huge, internet entertainment giant in China. So what I'm seeing with the retail investor who's investing, via insights from WeChat and executing via their phones is lottery-like behavior that drives huge idiosyncrasies. I remember vividly a couple of years ago when the president of China, President Xi, extended his tenure from a 2-term limit to a lifetime limit. Stocks with the name Emperor, or with the word Emperor in their name, rallied. They were up 10%, which is the maximum a Chinese security is allowed to move in a given day, while broad markets were flat. So absolutely, we see huge retail behavior in international markets, and that's what creates the inefficiency. As I said before, you see securities moving based on themes that are not related to fundamentals. For a disciplined investor who can get broad insights, develop a holistic view of a company, assess what's the fundamental value of a company, these types of mispricings is what creates the compelling entry point to get into a security and to actually generate, some reasonable value creation for the underlying client. So I see the rise of retail as significant opportunity see.
That's one of the most upbeat answers I've heard in a long time, because what you're saying is stock picking is back, fundamentals are back. It's not about passive investing anymore, which I think is super exciting. Chris, you work a lot with systematic and fundamental hedge funds, some of which I suspect were burnt, by the meme stock short squeezes. How have you seen their behaviors changing? Do they see this as an opportunity or as another risk factor? How are the hedge funds looking at this?
I think the easiest way is they're just taking anything that's, top 10 on Wall Street bets down to 0 weight, right? That's the easiest way, because a lot of these quant firms, they get, they have, stairway up, and then they get blown out by something that happens like this. That's like not a pretty typical quant return profile with stocks, right? You get hit in very specific names for M&A type reasons, for SPAC type reasons. So this is something that, like, index arb traders, for example, have been screening out SPACs for years. They never wanted exposure to these. There's no fundamentals behind them. They are lotto tickets, literally lotto tickets, and they'll move for whatever reason, right? So they've been screening out these types of companies for years. And I've been doing that for my clients over the last 2 years, just finding the Bloomberg field, how to screen out SPACs, just take it out of the Russell 3000, if they even creep their way in there, right? Certain things like that. So I think a lot of it is risk, but they have to be aware of it, right? So take ESG, for example. Maybe we're going to throw on another factor, meme stock mania factor to the ESG score that is, a myriad of other types of data that you just have to be aware of. So quants and index teams who have these large portfolios have the luxury of just throwing out 10 names a day. It doesn't really impact their benchmark or I would argue their returns. They're limiting their downside, which is a lot of how they, a lot of profit is just cutting your losses and avoiding the landmines. The other side of it is the discretionary firms who, they'll wake up one morning after doing months of research, they'll be short a name for 3-4 months, and they'll wake up, oh, BlackBerry's on the list again. What do we do? So I think they're just pretty much aggressively hedging these positions much more.
Yep.
And there's also these types of firms, the Citron research types of firms of the world that have just said, we're stepping back from shorting altogether, because this is it's a mania, right? So they're, the other option of the game is just to not play, right? That's how they win, is just to not play on that side. So that's what I've seen. And to I think Jess's point earlier, we can get into the data sets that are being used around this as well. But there's ways to either screen out or be made aware of these names. And I think that's really the way that it's trending. It will just die down into another factor. And I think that's the appropriate way for this whole thing to mature, is that it just becomes another data type that you need to have as an investor to clear any potential blind spots.
The thought that makes me have, Tim, having tied in, Asha's ESG expertise, those two things of this, like, lottery ticket, meme stock investing and the ESG, to me, they are both being driven by individual retail participants' preferences. Let's call them investor preferences, but they couldn't be more different. And I think the meme stock effect, I hope it's transitory, because I think it's, like, my own personal opinion, a broadly unhealthy sign of, like, wealth disparity and people being desperate to go buy lottery tickets. But let's put that aside. The ESG trend, to me, that's like here to stay, and it's generational. And that what's powerful about that, and institutional investors need to pay attention, is that you can look to Europe, and the standard has moved so far from where the standard is in the US. For Geode, we sit, as a sub-advisor to Fidelity, but we also sub-advise funds for Phil, which is the international arm of Fidelity. Yep. And talking to the, folks running the international arm of Fidelity, they are saying, hey, out of every 6 conversations we have with investors, and those aren't necessarily just retail investors, but if they are institutional investors representing large swaths of retail investors, sort of same thing, 5 out of 6 conversations is about ESG. 1 out of 6 is about performance. And when I heard that, I was like, oh my God, okay, wow, like, I buy it that way.
I bet there'll be regional differences.
I'm sure there's regional differences,
yeah.
but I mean, again, this is my personal opinion.
Yeah.
That's just a leading indicator. And we
Yeah.
in the US as asset managers have a N-year head start. We don't know how long it will take the US investor to get all the way there. But I personally believe they will get there and just have a demand
They were
for.
always behind Europe, right? Because of, I guess, PRI, but it feels like that gap's closed significantly.
I think so.
Franklin, your firm provides services into the advisor community, the RAAs, and is there any kind of impact there that you're seeing from your customers in terms of this boom in retail flow, which I guess is flow away from their services? They threaten this.
Yeah, there really hasn't been that much of an impact, partly because so many of the RAAs now, right, are model driven, right?
Yep.
So they're using outsourced models. There are only a few that we know that are using, that are basically developing them in-house. So they tend to avoid that, for the most part. But, back to this overall discussion, the one thing that we've got to be aware of is that this phenomenon that we're talking about now began in Q1 of 2020, and outside of a few painful short weeks there, right, it has effectively been straight up since, April, early May of 2020. We all know that markets don't go up forever, right? And the interesting thing is going to be what happens when the market starts going through one of its normal, rational downturns. And is the customer behavior going to change? And going back to the regulators, everybody may be upset with the regulators interfering with the lottery that's going on now, right? But how are they going to feel when their accounts have drifted down massively, right? And they're looking for somebody to blame, right? So that's usually when you get the regulations, right? We got regulations after 2008, right, for Dodd-Frank, because bad behavior, everybody wants you to come in and fix the problem after. So there's no appetite for it now. Just wait, whether it's 6 months or 3 years, right? That's when the appetite for regulation is going to come in.
Good. So let's talk data. This is the Data Minds panel. Monitoring fund flows, ownership, short interest, who owns what, to me was always kind of something a good investor should do as part of their kind of mosaic. Chris, what should investors be thinking to add to that mosaic? What new sources of information are out there? What are some of the challenges around gathering that information?
Sure. I think to start with Reddit and Wall Street Bets, there's firms who are selling this today, and there's firms who are avoiding it because it's not clear whether they can sell it or not. So, the firms who are selling it and the hedge funds who are buying it are operating in an area that's not treaded upon normally, where you can wake up one morning and the data is gone. That's how the contracts are written these days when it comes to Reddit. There's other ways to monitor that. I think social media had its heyday way back when, probably 4 or 5 years ago. A lot of firms in that space died out, and a few remain. So there's firms that take Twitter and stock twits and curate all sorts of accounts, and you can see when these things are going viral. You can derive the meme stocks from these data sets. So I can throw out vendors, since I'm not a hedge fund guy anymore. Social Market Analytics is the social media vendor in this space that they've been doing a great job for pretty much a decade in monitoring that. So I think increasingly that's becoming another building block of quant trading. You need to have some type of way to monitor these stocks, whether it's a meme craze or somebody getting thrown off of a United Airlines flight, which has nothing to do with meme stocks, right? That type of viral trading, the retail investor, goes well beyond the top 10 stocks, right? That are, that make the GameStop, AMC type of news every day. So I think that's one that's here to stay, social media. There's other vendors that are trying to monitor retail flow. So you've got more established vendors who will white label like actual trading flows from companies. But I think a real up and coming way, and a reason that I think retail investing is, I don't think that these we'll call them kids, they're a couple of years younger than me probably, are going away. If you look at these firms, look at Tip Ranks, look at TradingView. I mean, these firms have grown exponentially in terms of hundreds of millions of dollars that they've raised and millions of users that they're signing up. Benzinga is another one. There's just been a massive, I'm an investor in Benzinga, so there's been a massive amount of web traffic that goes to their website. People are looking for them to cover these smaller cap type of names. And these are other ways to monitor that. That's not very, data driven in terms of retail flow, buying and selling Apple or something like that, but monitoring how these companies are growing and innovating in this space is another reason I think it's here to stay. So, and then I think you've got the other types of things like short interest. That's always been around. It will continue to be around. There's a few juggernauts in that space, and it's just another building block you need to have. So to go back to index arb guys, they wanted to screen out names that had high utilization, right? Maybe everybody wants to do that now, or when it hits some type of level, even as a fundamental investor, you might not even touch a name, right? That is going to be, that data is here to stay.
Now, just before we move off short interest, that I think a lot of that data ultimately comes from the big exchanges, right? So I think NASDAQ have a product. Now, I'm pretty sure they don't have a retail version of that product that they provide in near real time. So how does that data get out to a retail investor to level that playing field? Or is that just something that will never happen?
There are free websites that offer some basic retail type of indicators. You have these firms popping up. They're partnering with companies like Fidelity. Here's our short interest indicator. So right. S3 was the one, like their guy was all over Twitter during this mania, kind of coaching people through this. How can you have over 100% short interest in a name and things like that? So I think that will start to permeate more into the retail market, these types of firms. But
you can today get, and Chris, you're the expert, but you can today get bi-weekly free exchange provided short interest data. So when I was back at Starmine, that was one of the first models that I built, and it worked. And I know people still use versions of it. Is we just use the publicly available. Now it's not, you can pay someone to aggregate it and clean it up, and you can buy that. But I could go to, and my favorite site at the time to go check my work was shortsqueeze.com, which I believe is still up. It's like actually, I feel like, I don't know if it's reputable, but like it's a pretty good website actually, with that shows that data. So that's free. And I remember when I built that model, there were two things that sort of flummoxed us, which we were just being acquired at the time, I think, and we didn't have the means to buy there's a vendor that has a more expensive, maybe it was Market or something. Anyway, somebody had
Market,
the more time.
S3 and FIS actually has like an intraday
FIS, one. Right? Yeah. Okay, so we wanted to buy that, and we knew that would then make our model that much better, right? Because we would have less latency. And then the other thing, though, was we would see this asymmetric risk profile of like you're right until you're wrong, and when you're wrong, it wipes out all of when you were right across like many names. So we spent so long trying to build the short squeeze predictor, and I'm sure there are other people, hopefully, who are on this call, or maybe you guys have tried. Building the short squeeze predictor is very hard. I do not believe that we were really able to do it.
I think it might have just got harder, actually.
I just think it's so hard. So, predicting uncommon events is not the forte of most quants. So we try to stay away from it. I guess that's what I'd say about that.
Yeah, I think that's been a common theme through this whole call. So Asha, Franklin, any other thoughts on data, how data needs are evolving, additional sources of data that you might want to look at?
I just think that it's funny you mentioned social market analytics, because we put them up as a vendor. We ran them through like a painful year-long process, and they actually looked like they had something there. But I think it was interesting because we actually ended up killing off, we used to, and I don't know if Fidelity's brought it back or not, we actually used to put the short sale interest out on the website that came from the exchanges until the exchanges started knocking on our doors and said, by the way, you've got to pay us some unconscionable amount of money. And it's the same data that anybody could get on the wallstreetjournal.com for free. But if we actually wanted to offer it, they all wanted like well north of 6 figures for that same data. And, you know, that's one area, going back to regulation, right? That's one of those areas where there's no reason why a retail investor should be squeezed out of having access to what is pretty fundamental data today, at least in terms of the way the market operates, right? And I think the SEC is trying to do that now with their alternative SIPs and other ways, right? Trying to break up some of those data monopolies that exist out there. But there's a lot of work to do in that area.
I think certainly my ex-colleagues at IEX would argue that the data is owned by, you know, the participants in the market and not by the exchanges.
Yeah, not that I couldn't believe how annoying it was that you could get the data from 2 weeks, but I was like, well, why then can't you just publish it every day on your website? I'm sure that is effectively free. Why are we downsampling this data for the retail investor, but we're giving it in real time to the institutional investor? Like that feels very, you know, if you want to pick a thing, I agree with you, Franklin, that the regulation will come when people lose their shirts and all the things that we overlooked and didn't mind about for a decade will suddenly get annoying. But that access to data about, you know, what is the information asymmetry? Like if the retail investor gets more and more informed and wants to be in there trading more and more, they should be looking at that information asymmetry and wanting access to that kind of information.
And that data, you know, there was an interesting ruling early this year. It's a patent ruling relating to software actually between Microsoft and Oracle. And it could pave the way to market data being considered uncopyrightable and being a fact. And because it's a fact, it can be freely copied and used broadly. And I really hope that that's the direction that the SEC will go in terms of pursuing that, because I think there are a lot of asymmetries in the market. And frankly, there's a lot of time, effort, and angst consumed because people don't know whether they're allowed to use the data here or there. You know, they don't know whether they can build it into their platform, this whole notion of derived data. And having to pay someone when you're taking a factual piece of information, you're still having to pay someone even though you've actually fundamentally changed that data. That sounds like another data mines topic we'll cover maybe another time. So I was hoping we would have some Q&A. It doesn't look like we've had any questions posed, so I'll just invite anyone on the call, if they have any questions for the panel, this is the time to put them in. And meanwhile, if there are any other thoughts or comments from anyone.
Well, I would maybe ask a question to Asha. We talked about data sources, but I'm surprised we didn't get to, you know, what do you think about the ESG data sources? You talked about disclosures. Obviously, that's going to generate more raw data, but, you know, what do you see as that climate of what folks are going to be, you know, needing to look at to be able to build ESG products that are sort of not greenwashing, but that are really based in something they can point to? Do you have any data or other based thoughts on that?
Yeah, so again, I think this could be a whole data mines panel. And I appreciate the question, Jess. I was actually just going to jump in with, you know, while we were waiting for questions from the audience, just a couple more views on the types of data items that I'm seeing becoming more and more relevant in the context of an institutional investment strategy. And I think it's a fascinating discussion, sort of where those asymmetries are. And you could argue they go in both directions, that there's access to insights that retail has that institutional doesn't, and vice versa. The reality is very much that we live in the era of big data, and information is traveling much faster and much further than it ever has before. And we're seeing, again, this is sort of the ESG view, the value in having a holistic view of companies. This is how I approach ESG. Financial statement data, news source-based data, pricing data, volume-related data, all of this is informative and important. And I see broad ESG data sets as giving us access to a more holistic view. on how to evaluate companies. It gives us insights on how governance is run, how employees view their company, the relationship with suppliers, relationship with customers. This is all critical, fundamental information. Deep analysis that occurs by fundamental investors is now enabled, by the quants, by having access to this type of data. Very hard to parse through, and I do think, again, not only do we live in the age of big data, but with the advancements in technology, machine learning, and other types of data science analytics, we can make use of this type of data. You mentioned greenwashing, Jess, huge issue. And this is where, I sort of began my comments around where I'm seeing SEC take action, or at least, consider action. How do we know what we're investing in is going to deliver some type of impact? How do we know that if a company is reporting on ESG related issues, that it can actually be accounted for, it's consistent from one company to another? I think there are a lot of open questions there. And I mentioned before, I see risk, in fact, to the ESG movement. These funds that have been labeled ESG and simply been constrained based on somewhat randomized considerations, when prices revert to fundamentals, you may very well see that those constrained portfolios underperform. So for ESG to have legs, I think it's really about looking at what are the indicators that are critical for investment performance, for corporate success. The types of indicators that I've been following, and I think that a lot of the ESG investors, this would certainly resonate. Clearly, governance is big. We all know that governance matters. I think it's the lowest hanging fruit across ESG, but understanding changes that are happening in management structures, relationships with boards, all of that governance related data is important. As it relates to social media and novel types of data, understanding controversial events. Chris had mentioned, the Boeing example, was it United, excuse me, the United example. These types of controversial events that cause significant reputational damage and prompt questions by investors more broadly, they're priced in differently today than they have been historically, right? Historically, it causes a reversion in the stock price. Any value factor would say, hey, this is a good entry point. I should go buy into the security now. I don't know that that's wrong. I'm a fan of a multi-factor approach. I think you want to track reversal signals, you want to track evaluation signals, but there's also a new element of risk that's embedded with the, with these new types of data being out there and the types of volumes that are following it. So controversial event-based data is something I'm tracking as well, and in fact incorporating in the constructs of risk modeling.
This is a little bit of a loaded question, I think. Of the population of retail investors, what percentage do you think are making informed, data-driven trades as opposed to trading on something like social media sentiment?
So if you look at that, I think there was a good rule of thumb that's been in place in the industry for literally for decades, and that somewhere between 80 and 90% of your trades are made by somewhere between 10 and 20% of your customers. And that's been pretty universal. If you look at almost any firm, you see that same kind of distribution. So while all those people on Wall Street bets are, getting the noise, the question really comes back to, but are those the people that are actually trading the volume? And the answer to that is probably no. And that, from working with retail investors and having worked with people like on the institutional side, there is a huge amount of disdain for retail investors. Like, they're not smart, they don't know what they're doing, et cetera. But if you talk to somebody, a retail investor who's been at it for 10 years, for 20 years, they look very much like an institution.
Yeah.
Right? They've got a structure, they've got a methodology, they've got an approach, they mine their data, whether they're an options trader or a straight equity trader, right? These are people that have actually put in place process and risk management, position sizing, the same good habits that you would see out of an institution, you see there. Because if they don't do that, they'd end up being ex-customers, right? And ex-investors, because they don't have any money left, right? I mean, we know, right, that a lot of these Robinhood people that are buying out of the money call options, they're going to be wrong at some point and they won't have a portfolio left anymore, right? And the people who stick around are the people who actually do have a process and they are well informed.
Yeah, I couldn't agree with that more, actually. I think the tools that are available now, which were only, to actually build and optimize a portfolio, 10 years ago, 15 years ago, you'd need a mainframe computer and a team of quants to do that. Now you can get tools online to do it. I think Microsoft just relaunched their financial services product within Excel. There's so much you can do now to be able to actually operate more like a professional investor. Now, I think it's going to be interesting to see how firms like Robinhood invest in education to bring those, maybe the younger demographic. At the end of the day, there's 900,000 accounts. I think the average size of the account was a couple of $100s. So that, in proportion to the whole market, they're small. But ultimately, I think they are the future investors in companies. And I think education is going to be a really important part of that.
Well, maybe one very short follow-up to what Franklin said, because I thought this was really interesting. When I was starting at Quantopian, we were looking at integrating with brokerages. And we were looking at the time at integrating with an FX brokerage. And I was like, okay, sure, whatever, looking into it. And a friend of mine was like, go to their webpage and go to their profitability statistics. They have to publish profitability statistics. And I was like, this can't be a right number because, I sort of think, oh, the market's kind of a zero-sum game. Oh, it'll be chance. No, 75, 85, 90% of the accounts are unprofitable. And you can basically run some very simple math to say these accounts have a half-life of 2 weeks. These people are losing all their money. And the only way there are people who are customers on this platform is that they're new customers. And the average churn is humongous.
Yep.
Right. So maybe an interesting way to say that question is all long-lived traders are good traders. And, those people who are not who are randomly playing the lottery are kind of going to zero. Now that's an unfortunate way to think about it, but I think that's what you've got. And, it doesn't mean that people can't be good traders or good investors who are individuals. It's that difference. I would just agree 1,000% of, process, is there data coming in? Are you applying risk management, right? Risk management, maybe that would be the number one, I would say. So
yeah.
If you look at a retail person and say, are they applying some of those things? Then, that's the way to know. I still think that is probably the minority of overall market participants, but that's no different knock on retail investors than kind of maybe on humans in general, is what I would think how that shakes out.
I think that's a great point. And the exciting thing is Robinhood is a publicly traded company, and we're going to see that play out in front of us and how those 22 million individual accounts churn and perform. Well, that brings us right to the top of the hour. So it just leaves me to thank everyone for joining the call. We'll be posting, I guess, a replay of the call. And thank you to the panel. I found that really interesting, I have to say. And it was really nice to see everyone's faces and talk about such a topical set of issues. So thank you again, and enjoy the rest of your week. Bye for now.